Hello, this is Chad Carnes, Chief Market Strategist at ETFGuide.com. Thanks for joining me today as I look at the housing market and if we're in a genuine housing recovery or is it more of just a relief rally. Recently, the S&P Case-Shiller Home Price Index showed a continued recovery in home prices as the average rose 10.9% in March 2013 from March 2012. Many media networks jumped on the opportunity to exclaim that the housing market has recovered, as one headline suggests, largest gains for home prices in 7 years. The average market has rebounded from its March 2012 price lows. However, the upper end of that rebound has been concentrated in markets that were at the epicenter of the housing bubble in the first place. Shown on this chart are Phoenix, San Francisco, and Las Vegas price history since the late 80s, and these three markets happen to be the largest gainers year over year at over 20% from March 2012 levels. Markets don't move in straight lines, they ebb and flow and they move up and down, and many times the further a market declines, the larger its bounce. Mathematically, this is necessary as a 50% decline requires a 100% advance just to return to previous price levels. This is what's occurred with the stock market since its 2009 lows, and is generally what is occurring now in the housing market. A 10.9% gain may seem huge, but given a low starting point, it may be misleading. To put it into perspective, another way to describe the recent housing price rebound is to say housing prices are now down only 27% from their peak decline of 34%. We should recognize that the markets that are driving the majority of the housing growth are the same markets that had the largest downside in the first place. A higher rebound is mathematically expected from them. The chart I have on the screen now shows this in more detail. The 20 markets measured by the Case-Shiller Index are shown in black and in order of their highest to lowest March 2013 year-over-year price rises, and those are shown by the blue bars. The markets that declined the most during the financial crisis are the same markets that just rose the most since March of 2012. Each market's peak year-over-year decline during the crisis is shown by the red bars. So for instance, Phoenix had approximately 35% peak year-over-year decline during the housing crisis, and Atlanta had a roughly 18% peak decline during the housing crisis. The red trend line shows that generally the more a market declined in the first place, the Phoenix, the San Franciscos, the Vegases, the Detroits, the Los Angeleses, Minneapolis, and San Diego, the more it has rebounded recently, shown by the blue bars. And the markets that were more immune to the housing crisis are the ones rebounding less. This is generally the ones on the right side that have the smaller red bars. That means that they had a smaller peak to trough decline during the housing crisis. For example, Dallas had a 6% year-over-year decline during the crisis. Boston's was only 8%. Dallas and Boston's rise the last year are two of the lowest at only 7%, trailed only by Cleveland and New York City, which also had relatively small peak-to-trough declines during the crisis. The largest markets now driving housing price gains are the more speculative markets that lost the most ground in the first place: the Phoenixes, the San Franciscos, the Las Vegases. So should we get excited about the recent rebound in home prices? You may or may not, depending on your market, but longer term this rebound looks to be nothing more than a relief rally that is natural in the ebbs and flows of markets. Many of the long-term fundamental reasons for housing growth are still missing in this recovery. Median household income remains down, and employment still is not growing at near the levels needed. Mortgage rates have started to creep up and may no longer be as big a catalyst as they once were. And building costs are not growing near as fast as existing home sale costs. Rental costs, too, will likely join that party. In fact, for more on the cost of building, you can go to ETFGuide.com and see an article I wrote on lumber recently, which has absolutely tumbled down about 25% within a month. And then I want to leave you with one more chart that shows, from a purely technical perspective, the recent price rises are nothing out of the ordinary, nor anything likely to get too excited about. The chart shows that the new housing starts, which is down at the bottom here, and single-family home transactions, which is the middle graph, are still well below any level reached in the 2000s. It puts into perspective the lack of rebound in sale prices since the housing low point, in reality how puny it has been. The top chart here is the housing index, which I just discussed, and you can see that prices are only back to 2004 levels. from their peaks in 2006. And it kind of shows how little, in reality, prices have rebounded. So I'm not thinking that this is a reason to get too excited about any recovery in the housing market. In fact, single-family homes and housing starts, their rebound is extremely small, as you can see, and only at a level that takes them back to the early 90s recession. That's the last time that housing starts and single-family transactions have been this low, since early 90s. Thanks for joining me today, and please check out some of our other videos on our YouTube channel and Twitter, as well as our many other investment tools and research over at etfguide.com. We recently redid our website too, so check it out. We offer a monthly newsletter, weekly ETF picks, and I also do a few times a week technical forecast. Thanks for joining.